As markets continue to digest the impact of COVID-19 and the policy responses to it on growth, inflation and returns, they're also starting to turn their attention to what the possible impact of COVID-19 might be on in terms of longer term returns. Does the event and the policy responses that we've seen to date and likely to see in the future increase the likelihood that we are going to move out of the regime that financial markets have found themselves in over the past, for much of the past 20 to 30 years, that being of a relatively strong growth and low inflation backdrop? If in fact that era is over, then we need to think about what the other possibilities are. And so in this chart in front of us, we've had an attempt at mapping out the last 90 to 100 years of growth and inflation using US data and attaching that to each of those periods a growth inflation regime. We've suggested 4 different growth and inflation regimes: strong growth, high inflation, strong growth, low inflation, low growth, low inflation, and low growth, high inflation. And on the chart here, just to explain, the strong growth, high inflation is the excuse me, is the light blue bars, and that's you can see those periods. And so the bars represent the average growth rate in GDP, and the lines on each of those bars represents the average CPI during those periods. So as you can see where the cursor is, it's a strong growth, high inflation regime. And you can see those over time, mostly during the 1970s and 1980s, but also around the Second World War. Strong growth, low inflation, of course, is the phase that we've been in for, as I said before, for much of the period since the early 1990s. It's represented by the light red or pink bars. Strong growth, for example, during the early to late 90s, growth in the order of 3.5% per annum, with inflation sitting in the low twos. And likewise, in the most recent phase that ended at the beginning of this year, at least temporarily, strong growth of around about 2.2% per annum, with inflation of under 2% per annum. Now, strong growth, you might say, well, hasn't been a strong growth, but it has been in excess of potential growth, and so we've classified that as still a strong growth, low inflation period. The other phases or regimes that we've identified here: low growth, low inflation, well, predominantly they're the recessionary periods that you can see during these periods, and also with low inflation, you might see the bars on those. So typically they're recessions. So they've had their own classification. And then low growth, high inflation, which really have only really occurred with any regularity, I suppose, in the 1970s, and then also around or just after the Second World War. So back to the opening question, this is what we've been in for the last, for a good part of the last 30 years. Are we about to enter into a new phase, and should it change the way we view portfolio construction? So the next step then is to look at returns in different phases, and so that we will begin to do shortly. And so what we've doing here now, I've identified this is real returns from US equities, once again using these different regimes. So the light blue bars represents, and let's just make this a bit larger, the light blue bars represents strong growth and high inflation, and these are the returns of the S&P 500 during those phases. The pink bars represents the average real returns during strong growth, low inflation periods. You can see those typically quite strong, and so on and so forth. And then recessionaries, well, the recession ones are interesting. Certainly over the past 3 recessions, returns have been very negative, and they were in the 1930s. During the 1940s, we had brief recessions, but actually, returns were still pretty solid during this period. As you can see, they're very short downturns. And then the red bars represent low growth, high inflation. People often talk about stagflationary periods, and I suppose that's what they are, represent sort of generally low volatile return backdrop. So just to sort of sum it up, what that has meant for different different asset class returns. So having done the exercise across all the asset classes, and again, I'm using US equity data in real terms here, triple B, long-term triple B credit, long-term bonds, US dollar gold price, and then US cash accumulation, expressing them in real terms and breaking their returns into the different regimes that have existed over the past 100 years. And as you can see here, the light blue bars represents low growth, high inflation. So in those periods, and again, we can think of the sort of 1970s stagflationary type periods. The best asset classes, certainly from a return perspective, has been gold, with credit, bonds, and equities all quite low, and cash. So cash probably in relatively terms, and certainly on a risk-adjusted basis, would stack up reasonably well. During the low growth, low inflation periods, these are, as I indicated, typically your recessionary periods. Once again, coming up strongest were bonds, gold, credit, followed by equities and cash. Strong growth, high inflation periods. So here we're sort of talking periods during the sort of 1980s, 1960s, also 1940s, periods during there. Strong growth, high inflation, so green bars. Equities have actually done reasonably well. Likewise, gold has done well, but bonds have not, and credit to a lesser extent. And then, as we've seen in recent times, the strong growth, low inflation regimes associated with very strong equity market performance, very good credit market performance, and less so on bonds, but still reasonable for bonds in real terms, falling away. So we think that depending on the regime that we find ourselves in, the return outlook will obviously be quite different. The policies that have been put in place in response to COVID, and the policies that could well be still to come, and we're talking very expansionary fiscal and monetary policy settings working together to some extent, yield curve targeting. We have to really ask ourselves, are we moving into a different regime? And if that is the case, then the return expectations that we've been using really for the last, or based on predominantly the last 20 to 30 years, could be somewhat misleading. So we need to somehow take into account probabilities or likelihoods or risks of falling into these other regimes, and we'll follow that in a lot more detail when we do our follow-up video to this one. Thank you.